And this is your clicker, sir, and it appears to be working. Right.
I traveled to Ireland just a couple weeks back.
But they could
Favorite was the distillers. Yeah, that basically went right away.
Ready? Ish.
10 seconds.
All right. 10 seconds. We have 10 seconds.
Nice. Yeah, you should give everybody here a heads up.
All right. I think we're ready to go. I'm David Allmer. I pretty much recognize everybody in here. Thank you for coming out for the meetup. I think we have a great speaker event tonight. As you know, I have to run through this little card of what's going on. For those of you who don't know, almost all of our candidates went to a training event this past weekend. So several good things there. Number one, we have enough money to get a national recognized communications trainer to come in and talk to our candidates about messaging and how to talk to voters and stuff. And we had so many candidates, we were able to fill the room. So it was nice to actually, you know, not just quote have candidates, but actually be working on developing them and developing the WakeLP. We also had several people go to a John Locke Foundation event on Friday afternoon. Yeah, that was Friday afternoon. Some good questions there, and I think quite a few people agreed with us when we asked some questions about education in the room. So, and Terry Stoops, who does education for John Locke and has been here before as a speaker, even offered to help, and I got an email from him today, so we'll see where that goes. Also, I don't know how long our donation tracker and Nation Builder has been going, and don't tell me, but for those of you who, this is fantastic news. If you remember in 2015, we raised, what, $1,000 in 1 year? We're coming up on 20 grand now in the WakeLP. So we are, normally I beg for money this time. I'm just going to thank you for sending it. We have several people, including Alex and Amy, who are going to be in Garner on 3 July for the Independence Day Festival. It's an important festival, and we're one of the few booths there. So thank you for volunteering and helping us. There is no meeting here on 4 July. Our speaker event on 18 July will be Van Staygood, and that's going to talk about the role of faith-based organizations in the community. You know, libertarians always talk about, well, government shouldn't do this, government shouldn't do that. We want to have somebody come and talk about alternatives that work. And then the last thing, as far as charity events as well, our charity event for 21 July will be the Interfaith Food Shuttle. I know some of you, like Brian Lewis and others in the room, have done that before. It's a lot of fun. And afterwards, Patrick has set up the Raleigh Rum Tour. So hopefully those of you who choose to do the Raleigh Rum Tour with us will also do the charity event beforehand. Yes. Right? That would be a good thing to do. A good person would do it in that order. All right. On that note, Ken Penkowski, who is not here tonight, suggested we have Marcus Buster come by and do a presentation on taxes. As we all know, Ken really loves paying taxes. So no surprise that he brags about his tax guy. Ken also gives me a lot of stuff, so he's not here tonight. I had his flight diverted to Pittsburgh, and so he's in the airport in Pittsburgh right now looking at all the great Steelers gear, which we all know the Steelers are fantastic. Alex, don't make me throw you out. So on that note, Marcus, take it away.
Turn on first. That would help, huh? Probably. Turn on. Just good?
Yeah.
It's all right? Yeah. Okay. Perfect. David, is there a camera you want me to look at? You're good. Yep.
You're good.
Perfect. All right. Good evening, everyone. How are we doing tonight? Good. Good. What's that?
Taxation is fast.
Yeah. Want to start off tonight by saying thank you to well, you all first for hosting me here. Special thanks to, as David said, Ken Mikowski, who can't be here tonight, unfortunately. But me and Ken are actually in this, one of the same networking groups. So it really means a lot to have the opportunity to come out and chat with you guys tonight. And also thank you to Patrick for helping to coordinate and organize some of this as well. So that said, we'll jump right into it. So to start off, a couple questions for you all. All right. Question number one. So satisfied, by a show of hands, who's satisfied with the taxes that they currently pay? Anybody? No hands, that's a shocker. All right, question number 2, and don't be shy. So if it's true, feel free to raise your hand, we won't judge you. Question number 2, who's confident that they're maximizing their deductions? Nobody again, really? Oh, 1, perfect, good. 2, perfect. I'm sure Ken would probably say yes as well, so we'll count him as number 3. And then question number 3 for you. Who's confident that they're getting the most proactive tax planning, tax advice that's available? Anybody? Awesome. Great. So, with that said, I know I saw a couple hands. With that said, that's fantastic. If you can answer yes to any of those questions, that means you're doing something right. If you didn't answer yes to any of those questions, there's some good news and there's some bad news, right? So I always like to start with the bad news. So the bad news is that you're probably right. You probably aren't paying too much in tax. You're probably not maximizing your deductions, and you're probably not getting the best proactive tax advice that you can. Now the good news with that is that it's not too late. And so what we're going to talk about today is the need for having a plan. Because all you need is a plan in order to take advantage of some of the opportunities available. So a little background on myself. As David said, I'm Marcus Lester, born and raised in Chesapeake, Virginia. However, moved to Raleigh, North Carolina about 3 years ago now. Went to school at the College of William & Mary in Lynchburg, Virginia. If you all are familiar with that, nice, quaint town just underneath Richmond in Virginia. And started working in the financial services industry when I moved here about 3 years ago. So little background on myself. I am what's known as an enrolled agent. So similar to CPA in many aspects. The difference is as an enrolled agent, I specialize in taxes. CPA is something specialized in taxes. There's many different industries areas they can practice in. On top of that, I'm also a certified tax coach. So as a certified tax coach is not one of the most well-known designations out there. Basically, the education to become a certified tax coach is based around advanced tax strategies. So a lot of the continuing ed, study material that I do is more so focused on advanced tax strategies for some individuals, but mostly for businesses, small businesses, if you will. So that's a little background on me, and we'll jump right into it here. So I had a few hands go up. I've got one more question for you, and please feel free to interact. Who knows what taxes are? Who wants to give me their definition of taxes? I know there's probably a bunch of different definitions out there, but let's see. This one.
Taxation. Taxation is the one state.
That's fantastic definition right there. You hit it on the head. Does anybody want to add to that? Any different ideas?
Reminder that you never actually owed anything.
That too, it can be.
Really annoying.
Those who are watching it, repeat it.
You're saying the question again?
Yeah.
Oh, what they say. Okay. So I heard taxation is theft. Yes. I also heard taxation is the realization you don't owe anything, which can be true as well. Any other interpretations of that word?
Completely voluntary donation to the IRS.
Completely voluntary donation to the IRS. Okay. Maybe a tax-free loan, possibly. I've heard that before. Or excuse me, a generous loan. Excuse me. My definition of tax are those things that nobody really knows about that end up costing the average family household about 40% of their income every year. Which, I mean, it's more than shelter, food, and clothing combined. Just to sum it up a little bit, taxes are basically rules, right? And as we learned when we were all little kids, rules must be followed. Unless, this is for you, David, you're this guy, right? Yeah, exactly. So any Patriots fans out there? Yes. Just one, okay. So I know who to avoid after I get done doing this. Gonna chase me down. And I'm a Dolphins fan, so I can't really say a whole lot with that. But yeah. So like I said, as we learn, the rules are rules, right? And you've got to follow the rules. Now, there's a couple different ways that you can not necessarily get around the rules, but maybe you can stretch the rules. You can make them work in your favor, and a lot of people do that. Now, the number one mistake when it comes to taxes is failing to have a plan. Now, that's pretty self-explanatory. A lot of folks, they think, okay, there's not much I can do during the course of the year. At the end of the year, I talk to my tax guy, I go to TurboTax and put my information in, and the tax liability that it calculates is what I have to pay, which is not always the case. And some of the big guys out there, I'm sure you all are familiar with Warren Buffett. Warren Buffett actually brags about how he's in a lower tax bracket than his own secretary. And actually, over the years, he's been around the 15% tax bracket, as much money as he makes every single year. Another example, General Electric. So they've been around for over 100 years. They've made billions and billions of dollars, and the last few decades or so, they haven't paid a single penny in tax. How does that work? And the reason why that works is because they've had effective tax plans. They've been proactive about minimizing their tax liability to plan for the future. So why tax planning? So two things. Tax planning, it guarantees results. Right? When you can look at a certain piece in the tax code and you can set things up to take advantage of what that particular law says, you are guaranteeing that result. Now, there is a lot of gray area with taxes. A lot of it is how you interpret that law. You really got to read the laws, so much like an attorney would read the law, right? The second piece is it's the key to financial defense. So financial offense is making more money. Financial defense is spending less. Like I said before, taxes are something that cost the average family about 40% of their income every single year. So how do we get around that? By spending less, possibly. Just an overview of the current situation. So as I know that you all have seen, and the reason why I'm here today is to talk about how the new tax law affects us and what we can do to maybe make it work in our favor. So the view from 30,000 feet. So 2017, end of the year, Congress passed a massive tax overhaul. Right? Now the goal of the tax overhaul, does anybody know what the goal of the tax reform was? Anybody want to take a shot? Yep. Sorry? Not quite. My interpretation. Sorry? That's what some of them say. My interpretation, to reduce the corporate taxes. Spot on, exactly. So the goal of tax reform was to reduce the corporate tax. Now that's not really fair though, is it? You can't just reduce the corporate tax and leave everybody else hanging. So with that, they also reduced taxes for pass-through entities, and they said they reduced taxes for individuals. Now there are some adjustments made that don't always make that the case. We'll run into an example later on in the presentation that may shed a little bit of light on it. But the ultimate goal was corporate tax reform. Little overview on how the tax system works. So I know that you all have been doing taxes for years, so you've probably seen a Form 1040, the basic individual tax return, plenty of times. But just a little overview on how that tax liability is calculated. So you start with your income. Right? Income can include everything from your ordinary income you make as a salary to your business income. Does anybody own a business here? Business owners, yep. So income you make a net profit, you make from your business to investment income, ordinary dividends, interest, gambling income, even illegal income is taxable, right? So, of course, Nobody's claiming their illegal income on a tax return, but income you get from anywhere is supposed to be reported to the IRS on your tax return. Once you have your income, you subtract any adjustments to income, and these are things like retirement plan or certain retirement plan deductions. Formerly, if you're self-employed in your business for yourself, you can deduct your self-employed health insurance. There's some other adjustments you can take.
Alimony.
Sorry?
Alimony.
Alimony, yes, which we'll talk about because actually it's changing the new tax law. So, but we'll discuss that in a second. But you arrive at what's known as your adjusted gross income from there. Then from there, you subtract either the standard deduction or your itemized deductions. So tax law has changed some of this, and we'll talk about how it's changed in a second here. Once you subtract your standard itemized deductions, you'll come to your taxable income, if you will. So you'll get to that figure, you'll consult the table of tax brackets, and you'll find the amount that you actually owe. From that point, you can offset that taxable income with certain tax credits. And then you add back additional taxes like your self-employment tax, net investment income tax, things of that nature, and you arrive at your total tax, which you then write a check to the IRS or to the state Department of Revenue, and you pay your liability there. Or, if you've done a good job, you may receive a small refund. So the key is to cutting tax. So that's how it works. Now, how do we reduce it, right? So that's what we're here for today. Keys to cutting tax. There's a bunch of different types of strategies available. Some timing-based strategies are things like, for example, deferring income to a future tax year via a 401k or a certain retirement plan instrument, right? And there's a whole host of ways you can do that. Then you've got shifting-based strategies. So these are things like if you own a business, hiring your kids in your business, which is shifting your income from your higher tax bracket to hopefully your kids' lower tax bracket. There's code-based strategies, which are all the little loopholes that I mentioned earlier, things like a medical expense reimbursement plan. So with that, there's a certain section of the tax code that allows you to take medical expenses and reimburse yourself via, this is if you own a business, it should be a certain type of business, you can reimburse yourself via the business and take a deduction on your business or on your business return or through your business, excuse me. And then there's product-based strategies, so things like separately managed accounts. Now the tax reform has focused mostly on the code-based strategies. So how does this all change with tax reform? So just a quick overview. Income is now, depending on the type of income, is subject to different tax rates. It's taxed differently. There's whole new tax brackets now. You've got things like dividend income, which is now subject to new thresholds. Capital gains, if you're familiar with capital gains income, it's now still taxed sort of the same as it was previously. You've got alimony income, as you mentioned, which is totally been revamped on the new tax code as well. Adjustments to income. So the major adjustments to income, the biggest one was alimony. Right. So now, starting in 2019, alimony payments will no longer be deductible to the for the payee amount. That's a major game changer. You've got things like moving expenses, which were typically deductible if you met certain criteria, which are only now available to active duty military personnel that meet certain criteria. You've got a couple other pieces as well that have changed. Importantly, the standard deduction has now changed as well as itemized deductions. So if you remember, after you take some of those adjustments to income there, you then deduct either a standard or an itemized amount from the number you get. So standard deduction has essentially doubled. So if you're married filing jointly, you formally could take about $12,000 as a deduction. That's now doubled to about $24,000 a year. The other thresholds have been increased as well. And this is very significant because this, in combination with the elimination of a lot of itemized tax deductions, are now going to lead a lot of people to take the standard deduction versus the itemized tax deduction. And this is the reason why. So typically, or before, itemized tax deductions, the way they worked was you ran through a list of different categories. So you had medical expenses, for example, medical and dental expenses. Now you can only deduct medical and dental expenses that were above a certain threshold on your personal return. With the new tax law, it was retroactive to 2017, the threshold has now been reduced. So you can deduct a little bit more, but still not completely all of your medical and dental expenses there. State and local taxes. Now this is a big one as well. So state taxes, local taxes, property taxes are now capped at a $10,000 deduction on your personal tax return. Then things like foreign taxes have changed, interest, casualty and theft losses. The big one at the bottom there, miscellaneous deductions. So before, you were allowed to deduct things like tax prep fees, certain brokerage expenses. That's now been eliminated completely. So just a little case study. Now this isn't always the case, but in this particular example, it's showing how tax reform has helped an individual or an individual family, pay a little bit less in tax. So 2017, if everyone can see, their adjusted gross income was $80,000. So after taking their standard deduction for a married family jointly couple, as well as a personal exemption for both the husband and the wife, their taxable income was decreased to $59,900, which, after calculating their tax bracket, gives them a tax liability of about $8,000. Now, with the new tax law, adjusted gross income stays the same. Their new standard deduction is $24,000. If you see, the itemized deduction is now going down a little bit. That's not significant because they're taking the standard anyway. You can take whichever one is more. But they're now getting $24,000 deduction as opposed to a $12,000 deduction roughly, which is great, except for the fact their personal exemptions have now been eliminated. So you can see the big fat zero right there. They're getting nothing as an exemption, which works out for them in the end. But this is very significant if you were, say, have a lot of personal exemptions. Say you've got maybe 4 or 5 kids, and you can no longer take personal exemptions for them. You may see your tax rate go up in the future. But as you can see here in the example, ultimately works out for them, and they're paying about $1,700 less than they were paying in 2017. So with all this said, it's great, right? So we may have a couple people who benefit from a lower tax bracket or a lower tax rate. We may have a couple people who benefit from some of the business taxes. However, watch out for 2026, because a lot of these changes will actually be phasing out from the beginning of tax reform to 2026. It's great to take advantage of things while you have the opportunity. Just a quick synopsis on how it affects businesses. This is really for business owners out there. So tax reform, like we said, the focus was on corporate tax reform. With that, there's been some opportunities created for small businesses, owners of pass-through businesses now benefit from a new kind of business deduction, if you will. But just a little rundown on how business taxes usually work is you've got 4 different business entities that you can be classified as. So you can be a sole proprietor, which is how a lot of people operate. You can be a partnership if you're in business with somebody else. You could be what's known as an S corporation or a C corporation. Now those are the 4 basics. A lot of people will say, oh, well, I'm an LLC, right? An LLC is, yes, a certain type of business, but it's taxed one of these 4 ways. So a lot of folks are an LLC. If you're in business for yourself and you haven't elected a special classification, you're taxed as a sole proprietor there. Now, if you elect a certain classification or a special, you file a special form with the IRS, you could be taxed as a S corporation or a C corporation. And there's some advantages to all of them right here. So for those that are sole proprietors, partnerships, S corporations, the benefit is tax reform has now created a new type of qualified business deduction for net income that you receive. It's known as the qualified business income deduction. And the opportunity is created is it basically gives you a 20% deduction on your net business income. So it's essentially free money on something that you don't have to change. You don't have to pay more money in order to get the deduction. They are saying, we helped out larger corporations. We're going to help out small businesses as well and pass this opportunity along to you. With that, there's certain ways that you qualify for it and that you miss out on. So that's the tricky thing. For that new deduction. So some strategies you can use to help reduce some of your taxable income, right? One of the best ones is choosing a good retirement plan. So depending on how your retirement plan is set up, contributions may be tax deductible. Now there's a couple different options you have. Some people like the Roth option, which is taxable now in the present, and it grows tax deferred throughout the course of your contributions, which is great. The way I decide on whether it's best to have a Roth versus a traditional retirement account is by estimating, what's your tax liability or what's your tax bracket going to be like in the future, right? If it's low right now and it's going to be high in the future, then maybe it's best to pay taxes right now when tax rates are low, and you can defer or eliminate the tax liability you have to pay in the future. If you think you're going to be in a higher tax bracket now as opposed to the future, maybe good to defer some of that income right now so that when you eventually withdraw, you'll be in a lower tax bracket. So it's looking at the long-term picture versus just a short-term picture. Another change, Obamacare repeal, right? Not really. So the only thing that's changed as far as taxes go with the Obamacare repeal is the elimination of the penalty, if you will. So there hasn't been any adjustments as far as that goes. Now, if you don't have health care, you just will not be subject to the, I believe it was about $700 penalty that you have to pay today. And that is, in a nutshell, kind of what you look for with tax planning. Right now, there's a whole host of other strategies out there, and there's way too many to really talk about right now. But you need to consider all the different variables. There's, like I said, opportunities to take advantage of loopholes in tax code. There's opportunities to shift income to, say, children or to different business entities, different assets, and defer some of that stuff. The whole idea is things have been written, right? Things are set in stone. You've just got to find an opportunity to take advantage of it. It's all about just looking for where some of these opportunities exist. So with that said, the whole process of tax planning, it works kind of like going to the doctor, right? What does the doctor do? They get you in, you do maybe your standard checkup, but they diagnose an issue, right? So what you want to do is you want to diagnose maybe issues you've been having or certain problems. From there, you got to do your research, right? You got to find a way to find a remedy for that particular diagnosis, and then you got to fill that prescription. And tax planning is the exact same thing. You've got to look for these different opportunities, right? You've got to play around with the numbers. You've got to make them work for you. There's definitely opportunities out there. You just got to know where to look. And like I said, these things have been around for years, right? Some of the wealthiest people in the world have been using some particular strategies to keep themselves in as low a tax bracket as possible. These opportunities are available for all of us out there as well. Just got to be proactive about planning and taking advantage. So with that, Marcus Lester with Heartland Tax. I'm going to open up the floor, I think, to any questions. Correct, David?
Yeah, we're gonna get questions for at least a few minutes. I normally don't have a lot of questions myself, but actually, this time I'm gonna have to ask first and go around the room. So, I mean, I guess for the group as a whole, like, this question was asked to Civitas, the whole room was retirees, so it wasn't quite answered fairly in a sense. How many people in here who currently work saw their taxes actually go down significantly in January or February? Like, actually, their paycheck saw a noticeable dip? Really? I see a bunch of like this, like you don't want to admit it. I mean, like, okay. I mean, it's fair. I mean, you, Cap, no? You guys didn't see your. Okay. I was just curious from the room because I mean, when I was at Civitas and they asked that question, my hand like went through the ceiling is because I was like super excited. But maybe that was just me then. Fair enough. So if you have a question, let me know and I'll run the mic to you. By the way, all that Trump money comes to the WakeLP, by the way. That cut really went to y'all.
So, do you recommend anything in particular as far as addressing state taxes as well as national taxes, or go with the same person for each? Like, how do you approach that?
You're saying as far as choosing a preparer goes to handle your state and federal taxes?
Yeah, like as far as making sure to get the most out of whoever you're working with for both sets of taxes.
Yeah, I would definitely recommend. I mean, if you got somebody that does your federal already, definitely have them do your state as well. A lot of taxpayers, they come in all shapes and sizes. North Carolina, I think we have a flat tax of I think it's 5 3/4 or so. With that, state tax isn't too complicated. So whoever you have doing it should be, if they're doing your federal return, should be fairly knowledgeable and should be straightforward when it comes to the state taxes.
Yeah, and then just one more. Where do you see things going from here? Do you see the taxes or the tax rollback, I guess, being implemented even further? Do you see it being reversed? How do you see things progressing?
Yeah, no, that's a great question. It's hard to say because at the moment, so a lot of the stuff that I've talked about now with all the changes, they've quote unquote rolled them out. However, they're realizing we've made a lot of mistakes. We've opened a lot of doors to people possibly manipulate the system. To people. Price, shocking, right? So with that, I believe that in the next few months or so, there will be some type of clarification as far as this is what we meant as far as taxes go. I mean, it's been evident if you remember back to before the new year, into 2017, a lot of folks were prepaying and deducting their property taxes, right? And what happened was a lot of the government basically said, you can't do that if you haven't been assessed the taxes for your property. So I mean, that just goes to show that they've written a lot of these things and they don't really have the details ironed out. So my opinion is, to be honest, I think that it's great for small businesses. I don't think it has as much benefit for the individual as the government says it does. I think it's here to stay for the foreseeable future. In 2026, it'll be hard to tell, I guess, what happens there. It's all obviously, depending on who's in office and who's in office. Right, exactly.
So I have a question. I got audited once. It was like the worst thing in the world. So is there anything that is like a red flag for being audited? I wasn't sure. To this day, I'm not sure why I was audited, but are there any red flags that the government kind of looks for that I can avoid to not have that ever happen again?
Yeah, definitely. What did they say what it was for?
No. They said it was random.
Random. Yep, so some are random, yes, but there are certain things that do give off a red flag. put you at further risk of audit. A lot of it is income related. So, and it may not be your mistake. So it could be, for example, an employer misreporting income, underreporting income. Because when the IRS looks at things, the records have to match. So what your company's reported and what you've reported, they have to add up. If they don't, then it's immediate red flag there. That can be some of the first things to look at. For business owners, it's, you know, depending on how you're set up, you may be at higher risk of audit because it's more so based on trust, right? You're expensing certain items, you're claiming certain deductions on your tax return, and the government's going to want to see proof of those particular deductions there. So as far as audit for the individual goes, there's not a whole lot, I wouldn't say, unless just income gets mixed up. For businesses, there's certain ways you can reduce your risk of audit depending on how you set up as far as business entity structure, as far as the deductions that you claim. With that, audit isn't always bad. I've gone back and forth with a couple auditors before, and it's funny, you know, a lot of them, although that's their job, they don't quite know the tax law like they should. I just find that ironic. But with that, sometimes it's them thinking that they've caught something, and it's just you saying, no, this is not what happened, no, this is how I documented it. But
so first I have a comment that as a financial advisor, if you have an accountant or a tax preparer who is not telling you you need to do something differently, you need to get a different tax preparer. Because all he's doing is filing a report for you, he's not really giving any tax advice. But going back to the alimony, it sounds like they're really penalizing the higher income of the spouse, because if you can't deduct it, it probably means that the other person isn't claiming it.
Yep.
And they're penalizing the higher deductible. And then going back to your question about audits as self-employed, I've heard two opinions on this. One was if you claim a home office, there used to be a red flag for an audit, but I think there's so many people that work at home now that it's not that much an issue anymore.
right, yes. So just to answer the home office one, that's one that a lot of people think goes off a red flag, and it's not always the case. Actually, depends on how you do it, right? On the tax return, there's actually a section where they allow you to take a standard deduction for the home office. With that said, there's some very, very specific rules that come into play if you're taking a home office deduction. It's got to be used exclusively for that particular business, right? You can't have a home office with a bed right in the middle of the home office. The IRS is going to buy that. So you just got to be smart about it, if you will. And then your second question was alimony related, correct? Can you repeat what you?
Just that they're penalizing the higher income earner as opposed to the lower income.
Right, yeah. So what he said was, in terms of alimony, with it not being deductible to the payee and taxable to the recipient, exactly, they are essentially penalizing the folks that are paying the alimony, right? The higher income folks, which is a huge change. Is going to change some major ways that I think just divorce decrees work and whatnot. But unfortunately, it's one of those things that there's nothing you can really do. It's just you're stuck with it.
Prepay alimony.
Depends on the divorce decree, from my understanding, and the agreement. But with that said, it may be cheaper if anybody's thinking about it. It may be cheaper to get a divorce now, so you can avoid those higher taxes in the future. But yeah, not condoning that, but.
Isn't that going to put people? I mean, there are people that would slide a lot more, just like they don't want to pay child support. Even less do they want to pay alimony, give them more of a reason to kind of play games than they might have otherwise.
Exactly.
Repeat the question, please.
Yep. So, question was, with the alimony changes, will it give people an incentive to basically commit acts of fraud like they do with child support? And yes, I totally believe that it probably will. Unfortunately, there's nothing you can do about it. it's just job of the IRS to catch those folks down.
So it's not a question, it's just a comment. I want to make sure you realize that corporations do not pay taxes, people pay taxes. So any reduction in the corporate income tax is a good thing. It makes us more competitive with the other nations of the world.
Agreed, yes.
Okay. Oh, I also had a question from Ken earlier is, should I be afraid of the IRS?
No.
Why? Because they really are terrifying for some people.
They're terrifying.
Yeah. And that's the way they come across. Like I said, if you have done everything that you're supposed to be doing, then there's no reason to be afraid.
No. That sounds too much like you have nothing to hide, you have nothing to fear. That sounds too much like ICE.
I actually know somebody who had a problem one year, and about 3 years later, they got a notice from the IRS, and they were terrified because they had such a problem 3-4 years earlier, and they had a refund of like $2,000 that they said that they didn't even put it in for. The IRS told them that there had been a mistake in there and they had paid too many taxes, and they got this refund check, and they were like, wow, like they would never have known. So I guess, there are unusual circumstances. Not everybody has a totally bad experience, because I would be surprised. I would think that if you didn't know that you overpaid them, it would kind of sit in their bank account. But they just got a check for $2,000, and they thought they were going to be under investigation.
Right.
Okay, so for the sake of others so they can hear, it's important that you have the microphone when it's going to be a long question and stuff. So just give a second. I'll give it to Brian Lewis and I'll bring it back over that way.
So, touch back on the state tax question. One of the big reports that came out was that a lot of states, in what would be, in my opinion, lazy legislation, tied their deduction rates to what the federal deductions were. And by the elimination of a wide swath of deductions, by increasing the standard, a lot of states were put in a position where they don't have a number to target those deductions off of. Are you aware of which deductions North Carolina offered that were tied in such a way and leave us in a legislative crunch?
Good question. I'm not aware of the particular deductions that they are targeting. From my understanding, it'll probably be dependent on whatever they figure out federally. And the issue is there's just so much in limbo federally to where states, they don't know. Nobody really knows. I actually was in a tax conference in San Diego last week with some very experienced, well-educated tax attorneys, CPAs, all sorts of guys. And we were talking about California's state tax law, which California is one of the trickiest states as far as state tax goes. And same thing with them, they were all in limbo. So they were saying that it really is going to be based off of what they ironed out as far as detail goes in the federal tax reform. And that'll trickle down to the states. Now, to be, as we are in North Carolina, I'm not sure exactly which deductions that will affect, though.
You have a question?
My only question, I mean, it's going to sound, everybody's got a reason for being here, but when I'm from Florida, we don't have state taxes. And we don't only do not have state taxes, but we don't, like if I go to the store and buy lentils, a bag of lentils, I lived here 6 months before I realized I was paying taxes on groceries because until I went in to get one item and the guy goes, well, it's taxes. And I'm like, it's lentils. And he goes, yeah, well, we have farms. And I'm like, we have farms in Florida too. So I would think taxing, I mean, I've been told that, I don't know if this is true, you probably would. They jokingly call North Carolina the New York of the South because it supposedly has the highest taxes. So if a person had a job that they could move, why would you live in a state like North Carolina where you're paying out taxes on the state taxes? And they're vicious. The state will really go after the state taxes when you can live in a place like in Florida where there are places in Florida cost of living are not that high and you're never paying state taxes.
Alligators.
There are not everybody lives in Miami Beach.
Florida could do that thing. in Florida.
Yeah, so I also grew up in Florida. They have a sales tax. There's no income tax, but there's a heavy sales tax, which is fairly regressive. Just depends on how you want to run your state or what have you.
Exactly.
Go ahead.
Yeah. So I'm just kind of agree with Dave.
Is it the highest tax?
North Carolina? Oh, no. Yeah, we're 5 3/4. There's some, sorry,
From the south, from this region.
in the South?
We're lower than South Carolina. and
It's just been
Virginia.
reduced in the
South?
last year.
No, I wouldn't say it's the highest. Like Dave said, it really depends on, where you are and what they're looking to do with the state. If they're trying to attract investment from elsewhere, then obviously you may decrease your state taxes in order to do that. So North Carolina isn't too bad. I know historically, I've only been here for 3 years, but I know historically they've kind of fluctuated with how state taxes were. I think they were on using a marginal rate before, but now they've adopted a flat state tax.
The current flat rate for all income tax is 5.499 currently, and that came down from what was around 7.5 before the GOP got in the NCGA.
Gotcha. All right, so
And it was tiered. It was tiered, but it was like 7 and 7.5 and close to 8. So now it's 5.49, and next year it will be 5.25.
So
yay.
yeah, exactly, opportunity, right? I think that goes into just the growth of the state and some of the opportunities here as well.
So 2 follow-up questions, and then you know what?
Mike, close to your mouth.
The deduction for children was going away. So we have the same road there. I thought there was an increase in tax deductions for children.
So the personal exemption deduction that you can take for your dependents is being eliminated, yes. With that though, there is an increase in the child tax credit. So there's a little bit of give, a little bit of take. Obviously, it's going to depend on your unique situation, if that leads to you saving more or paying more. But yes, personal exemptions are going to be eliminated starting 2018, or getting it 2018, so a few months ago.
So what is it now?
Amount of the exemption?
Yeah.
Now it's about $4,000 per dependent. So the big effect of that is how it relates to the standard deduction. Because what they've done is they've doubled the standard deduction and completely eliminated exemptions. So it really applies if you've got a lot of dependents, right? You're not going to be able to deduct nearly as much. But if you don't have as many, then you may benefit from a doubling in the standard deduction.
I'll come to Brian next. Okay, you got a question too?
On the 20%, how do I tell if my business is a qualifying business or not?
Yep, so the question was, how do you tell if you qualify for the 20% deduction on business income? So they've made this law extremely complicated. The way you qualify is your net income needs to fall underneath 2 different thresholds depending on your filing status. So if you're single, you need to have net income or taxable income, whichever one is lower than $157,500. So if you make less than $157,500, $157,500, then you qualify for this 20% reduction. If you make over that amount, then you're what's called your phased in for the deduction. Phased in, phased out, basically means you don't qualify for as much of the deduction above that threshold. Now I know maybe that's clear as mud. What you really need to know as far as the 20% deduction goes though, is if you can get your income below those thresholds, then you will qualify, you'll be okay. If you're a 1099 employee, or you're saying if you're paid on a 1099, so like you're a sole proprietor? The 20% deduction only applies to pass-through business entities, so sole proprietors, partnerships, and S corporations. If you're a C corporation, which is the actual, what's known as a corporation, then it does not apply at all. So you have to make sure you're underneath those thresholds there. As long as you're, this is where it gets even trickier. You can't be a certain type of business as well. So like certain accounting firms that meet certain criteria, medical practices that meet certain criteria, they may not qualify for this special deduction as well. So I don't know if that confused me even more.
Go get two more questions. We got Brian over here.
So first is a comment regarding the standard deduction. Part of what that's going to do is because you can't boost your deductions, but some I don't know, but as far as going back to the qualified deduction for a qualified business, one of the things that you can do is increasing your retirement contributions. I'm assuming it's based on AGI, that the 20% is based on AGI, but if you make increase, if there's a way to increase the amount of the deductible for your retirement plan contributions, then you make yourself qualified as opposed to not doing anything. And it goes back to what you said as far as planning and the phase out. But the one thing you didn't touch on was the alternative minimum tax. They seem to have eliminated, which has really been costing a lot of people a lot of money because it's something that wasn't indexed for inflation. And it really costs a lot of people. If you didn't do the planning and you just went on along, as I tell clients, you go along fat, happy, and stupid, and you don't do any looking, then the alternative minimum tax is going to bite you in the butt.
Exactly, spot on. So the alternative minimum tax, if you're not familiar with that, basically what it's there for is to prevent people from really, really gaming the system. So there's this saying that the saying is, pigs get fed, hogs get slaughtered, right? So the whole idea with that, with the alternative minimum tax, it was set up so the hogs that were trying to take every deduction that they could possibly take are now being forced to pay their fair share of taxes, which, yeah, it's fair to say.
For example, municipal bond income is not
Exactly, right. And so what Brian was saying was the alternative minimum tax is based on certain types of income you have. Now it's subject to lower thresholds, but it just makes the idea of planning that much more important. And then the first comment you had, remind me, it was in terms of the
standard deduction and fraud.
Right, standard deduction versus itemized deduction. So what Brian said was the standard deduction increase is basically being used to eliminate gaming the system as far as itemized deductions go, which, yes, is the case, because what a lot of folks would do was you would take a significant amount of itemized deductions and you would pay a whole lot less than you would if you just took the standard. So with the kind of capping of some of the very widely used itemized deductions, property taxes, mortgage interest, miscellaneous deductions, now it's kind of creating a even playing field, if you will, for standard versus itemized.
All right, I'm going to do the last question, because more broadly in this political organization. Taxes and fairness always comes up. So for example, one person might be W-2, have their house paid off, their kids are gone, they don't have educational deductions, and they just take that. It's almost like a flat tax in the sense there's just not a lot of places to maybe hide that money. Might know somebody else in a similar income bracket who is able to run his own business, brag about all his deductions and everything. You realize you're making similar amounts of money on the front, and then he tells you he paid $0 in taxes. That sounds inherently unfair, right? Even for two people that are maybe both have good incomes, when one says, yeah, I ate that, and the other person says no. So based on your experience and all these, all the tax work you do, I'll ask you, do you think the system is fair? Does it work?
Do I think it's fair? Not at all. And as you said, Dave, you have folks like you all. You work hard for what you have. Everybody does, right? It can be a grind at times. And why is it fair that you work just as hard as somebody else, but they benefit more from that opportunity? And It is not fair, but what you have to remember, and I'm sure you guys know this better than anybody, is tax system is set up to benefit the people at the top. Right? So whoever is controlling things, inherently these things are set up so that they can benefit either directly or indirectly. So unfortunately, that's the way that things are.
I understand.
Yeah.
So I mean, with that, not that you want to be out of a job, and not that anybody wants to pay taxes. Last question, flat tax, fair tax? Hey, go with fair tax. You think that works or not? Because I get that question a lot.
Yes, I think it can. Obviously, there's so many other factors that go into it, but yes, I think it can.
All right. Well, I appreciate you coming out.
Yep.
You can have a tasty beverage in that. And I have something else for you that I will get for you in a moment. And we have gotten great service again, as always, from Santana and Heather, who is new, I think, as well. Yeah, don't drop that. But fantastic. All right. Thank you, everyone, for coming. And glad I was able to get this video thing going. All right. Thanks, everyone.
Thank you, guys.
Bye.